Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Jim Rickards, prolific author, and he's also the chief global strategist at Meraglim. Jim, welcome back.
Thank you, Max.
All right, Meraglim, what is it?
Meraglim's a company I started with some partners about a year ago. We are specialized in predictive analytics in capital markets. It's actually the continuation of Project Prophecy, which I worked on at the CIA. Project Prophecy, actually, we're down here in your studio, very close to the former site of the Twin Towers. There was insider trading in advance of the 9/11 attack. After the attack, the CIA said, well, if there's going to be another spectacular attack, would there be insider trading again? Could you identify it? Could you trace it to the source, get a FISA warrant, break down the door, and stop the attack? That was Project Prophecy. I was one of the co-managers on that. And basically, we developed a predictive analytics system inside the CIA that worked extremely well. All that's happened now is I've taken that technology with some partners, with some investors. We're now doing a private version of that to do predictive analytics in capital markets. However, we've gone well beyond what we did at the CIA. As you know, technology's advanced, science is advanced, so we've really got third wave artificial intelligence and some other inputs to that to come up with a very robust system. Okay, now,
remember Poindexter? What was his name? John Poindexter?
Admiral John Poindexter, okay.
Yeah, he came, after 9/11, I think it was, he came up with a market. What was it called?
Well, there was TIA, Total Information Awareness. That was his project. But they wanted a futures market, basically a geopolitical futures market. So you could bet on whether at the time Yasser Arafat was going to be assassinated. He's died.
Right. Well, the whole thing was modeled on my Hollywood Stock Exchange.
Well,
did you know that? It was based on my technology.
I did not know it was based on that technology. Yeah. I do know that this is sort of what they call the wisdom of crowds. If you get enough people making enough bets, that on average they'll have better prediction than an analyst sitting in a cubicle. That's
at the time when they launched it, there was a lot of pushback because they said, hey, there's a conflict here because terrorists can bet on the terror act, and then they go out and commit the act, and they cash in.
Well, that was one of the objections, but specifically one of the contracts was, would Yasser Arafat be assassinated? And the pushback came from then Senator Hillary Clinton, who was a New York senator at the time, who of course was a good friend of Arafat. So that was shut down, but we were working. That was actually DARPA, the Defense project research arm, but we were doing it inside the CIA, so we sort of dodged those bullets, if you will.
So it's not really a prediction market as such. You're using predictive analytics. So you're looking at the data, and you are using algorithms, and you are sorting through the data to try to pick up on patterns, and this is all internal. It's not out there. People are not buying and selling prediction contracts as such.
Correct. We're not running a prediction market. We're running predictive analytics, but the science has really moved on. There's less there than we see out with the wisdom of crowds. Wisdom of crowds is really good if you want to guess the number of jelly beans in a jar. The average of 1,000 people with no mathematical understanding will actually be pretty good. Guess the weight of the cow like at an old English fair. That stuff works good. But the more complex the problem, the less the wisdom of crowds works. And for example, even in markets where you have a lot of participation, so let's go back to February 27th, 2017, earlier this year. The market was giving a 30% chance of a Fed rate hike in March. The Fed actually did hike rates in March. Now, it got to 100% the day before the meeting, but there's an example where the market was way off. And that's okay. It doesn't mean markets aren't valuable, but there's a lot more to it. We use, basically, we use complexity theory, behavioral psychology, history, and other branches of science to come up with our forecasts.
Okay, so you say this is an outgrowth of your work. I believe it was in Death of the Dollar, where the Chapter 1?
The Death of Money, Chapter 1.
Death of Money, Chapter 1. Right. Okay, the 9/11, you were observing, as well as your colleagues in the intelligence community, activity in the financial markets that telegraphed that something was coming.
We were not observing it in real time. It was there. That information was there, and I did run into people later who saw that. The CIA was not observing that at the time. But after the fact, you could look back, and it was very obvious. It was done through buying put options. Usually insider trading is done in the options market because there's a lot more leverage. That's the first place the SEC looks, by the way. So on 2 trading days before 9/11, buying puts in American Airlines 286 times the average daily volume. So that's like I order a Big Mac every day, and then one day I order 286 Big Macs. You know something's up. I talked to John Mulhern.
So you're saying after the fact, you looked at the data and you said, oh my gosh, some of this knowledge was circulating ahead of the event.
Not just me, not just the agency, but there were academics. I talked to John Mulhern, who was the specialist. John Mulhern's a New York Stock Exchange specialist firm, made markets in America and United. He was the market maker in those two stocks.
Okay, so like in
And he
context,
said, I've never seen more blatant insider trading.
when the Space Shuttle Challenger blew up, Morton Thiokol, the contractor for the booster rocket, puts, in this case, skyrocketed because the thing just blew up. Here you were observing the event as if something had blown up before it blew up.
Correct.
In the post-event, you're looking back and you're seeing that. Right. And so now markets are very sensitive to this data. And how much of the predictive analytics that you are incorporating in this service is taken from market data?
Well, we start with market data, and that's there are many, many examples. By the way, you have to separate sort of predictive analytics on the one hand and like law enforcement looking for insider traders and all that, but there's insider trading all the time ahead of M&A announcements, so that's quite common. You can always see that. You usually see it before the fact, definitely see it after the fact. But we're using that, we're using market data, but we're also using complexity theory, which says that in any system, the scale of the system, scaling metrics are very important, and the density function, the interconnectedness, that's a leading indicator of a potential collapse or,
Okay, so what's the ratio between market data and non-market data, roughly?
Well, it's hard to say. It depends on the particular node. See, we take all this, so we use behavioral psychology. So that's very well established. Heuristics, biases. People would rather take $3 as a sure thing instead of $3.20 expected value if there's a 20% chance of loss. Risk aversion, anchoring, all these behavioral biases have been very well known. You can incorporate that. We use history. A lot of what Wall Street does, they use correlations and regressions. There are a lot of limitations on that. Number one, you'll never see the weird event. You'll never see a recession. You'll never see a so-called black swan. You'll never see a catastrophic event. You'll never see that in the correlations. You'll always predict more of the same. You get random outcomes, which is not true. Things are path dependent, number one. Number two, the time series are often too short. I like 100, 500. I even use 1,500-year time series. Go back to the collapse of Bronze Age civilization, the collapse of the Roman Empire. We're about due for another civilizational collapse. You don't predict that tomorrow morning, but those are the kind of time series that are more meaningful in my view. So we use history. We use Bayes' rule, which is a statistical method that involves just kind of starting with a hypothesis, using the best data you can. That we use that in the intelligence community all the time. That was used to that movie, the Imitation Game, where Alan Turing cracked the Enigma code. That was using Bayes' rule and so forth. We use all of that, but the thing is, you have to take all that and combine it in what we call a fuzzy cognitive network, just a neural network with nodes. Each node might represent a different one of the disciplines I mentioned. One might be an historical node. It has some weight because something happened before. One might be a Bayesian node. It gains weight or loses weight based on updating. Now you have to feed those nodes. To do that, we've teamed with IBM and their Idea Lab and Watson. Watson can read 200 million Twitter feeds simultaneously. I might look at 10, but 200 million. And with plain language ability in 8 languages. So now we've really gone way beyond. This is really third wave artificial intelligence, as I described.
Okay, so as always in these situations, you have a problem. I guess you could call it of slippage. For example, arbitrage opportunities open up in the market.
Sure. And
then everyone jumps in on those arbitrage opportunities. By a spread between T-bills in one market versus another market. The ARBs come in, and it shrinks down to zero.
Right.
In this type of work, and I know having created the Hollywood Stock Exchange and invented the prediction market industry, thank you, you have the problem of, and this happens in markets all the time, where you are, the intelligence that you think you're gleaning as far as a predictive intelligence starts to get discounted by the fact that you're looking at the intelligence. It's almost a Heisenberg effect of if you actually start to see it, it'll start to disappear type of phenomenon. And it doesn't mitigate the risk of a black swan. These black swans are there because they are black swans. Do you feel comfortable that your work, to what degree is it let's say, a leap forward in generating? Do you know yet? Did you have any track record on this yet? What's the status of this?
Well, we do have a track record. First of all, we predicted Brexit. We said the UK would vote to leave the European Union. That was a completely out of consensus view. We predicted Trump's election. I was on television in Australia, New York, Europe before the election saying Trump was going to win. So we predicted a Fed rate hike in last March at a time when the market was giving a 30% probability, which was true from December to late February. We were at an 80% probability. Now, the market caught up in the last 2 weeks.
Is there a problem with...
So, yeah, we have a good track record.
Data apartheid. And what I mean is, you've got access to the data, you're making predictions, you can cash in on those predictions. Not that that's your point, the reason you're doing it.
We don't trade.
But that can be,
service.
available to hedge funds who pay big money to the intelligence committee. They've got CIA guys on their payroll, so suddenly they access to data gives them an edge. Now they're profiting from this data, and the average Joe in the street is not profiting from this data. What's your thought about that?
Well, first of all, you're absolutely right about that. And it was one of the things I said when I got to the CIA and we were talking about this. This was all new. The CIA hadn't done. There's one guy they put in charge of this because he traded options like in his spare time. He was a math whiz and just traded options for his personal account. They said he was like the only guy in the agency who did that. They said, okay, you're in charge. They didn't have capital markets expertise. Capital markets were not part of the battle space prior to 9/11. They are now, but they weren't at the time. So, but I give the CIA a lot of credit. They know what they don't know, and they're very good at outreach. And I was not the only one recruited. There were many who were invited into this project, so we kind of built it from the ground up. But one of the things I said to them, I said, guys, hedge funds do this all the time. We're not trying to do anything the hedge funds don't already do. We're just doing it for different reasons. We're not trying to spot insider trading ahead of an M&A announcement. We're trying to spot insider trading ahead of a terrorist attack. But the way you do it, the math and the data inputs are the same, number one. Number two, as far as data feeds, they're not cheap, but for $25,000, you can get real-time prices from Chicago Mercantile Exchange, New York Stock Exchange. So all that information is available. But,
the algorithms and all the computer science and the engineers,
you have to build
you've got
that.
legions of these guys.
You've got to build that yourself.
Those are expensive.
They are expensive, and you have to build that yourself. So there is a little bit of that, but this is. It's not in. I mean, I'll give you an example. You can rent satellites for satellites in space that are private. You can rent space. You can rent the use of them. There were people like following Cracker Barrel. Now, nobody walks to a Cracker Barrel. They're all by the highways. You drive to a Cracker Barrel.
I know. Yes.
So they were using the satellites to spot how many cars were in the parking lot. They had some data on the average sale per car, average number of people per car, and they used that to predict the earnings of Cracker Barrel. And that's completely legal. It's inside information, but it's either to be guilty of trading inside information is a two-part test. It has to be material non-public information, but it also has to be acquired in breach of a fiduciary duty. If you do it yourself, you haven't breached any duty. It's your information. You can't steal from yourself. So that's completely legal insider trading.
Right. On Wall Street, we used to say it's insight, not inside.
Well, no one likes the word insider, but the fact is, if you invent it yourself, you're not stealing it, so it's legal. But yeah, do those funds have an edge over everyday investors? Of course they do. I mean, that's just the way it is.
Okay, well, as usual, we didn't get past the first question, but we're going to keep you over for another segment, if that's okay.
That's fine.
All right. And that's going to do it for this edition of the Keiser Report. With me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Jim Rickards, prolific author and data guy. If you want to reach us on Twitter, it's Keiser Report. Until next time, bye, y'all.